Well, after some explosive moves and markets that just continually go higher and higher, we question now whether these momentum beneficiaries are over, whether the trade's done, or whether it's time to rebuy back into some of these trades. Obviously, we've seen gold trade up to 4,381. It pulled back to 4,004, and we're finding a little bit of support coming into that. But we have a look at some of the other momentum trades recently. AI winners, the short interest baskets, which have worked very well as shorts have recovered. The retail trader favorites playing through, the momentum beneficiaries, all of these stocks, all of these positions have started to come unwound a little bit as some of the fast money comes out of this, and markets with a very extended position calls that into question. And we look at some of the risks that permutate through the system in the coming week ahead and weeks ahead to look at whether those positions continue to be unwound. Obviously, we're seeing crypto at some key levels. It hasn't really been the same sort of momentum beneficiary. We're seeing some like gold or AI winners, for example, but certainly we are seeing some of these cryptos trading at the bottom end of the range at some fairly precarious levels, which we look at as well. We have a look at the US-China trade deal. We have a look at other factors going through the market, the technical setups that we like, the trades we like, the directional skew, as we go into this week's trade-off. Hi, I'm Chris Weston, Head of Research here at Pepperstone. I'm joined in 2 seconds by Blake Morrow from Forex Analytics. And as always, we'll be discussing all the charts that matter, the themes, the movers and shakers. And we've been away for a couple of weeks, so it's good to be back in the house. Good to be back talking markets with you guys. And certainly good to be talking markets with my man, Blake Morrow. Come into the show, my good sir. How are you?
Hey, I'm doing well, Chris. I've missed you. I missed everybody. I missed the crew. I miss all of our viewers. So it's nice to be back with everybody.
Well, maybe it doesn't look like I have, but I haven't eaten for 2 weeks. I've been shaking, but now it sounds like I've re-established my form as you've come back, mate. So thank you for joining us. I've seen some pictures of you and the boys on tour. Looks like you're acting like 21-year-olds again, as opposed to how I'm not going to ask how old you are now, but yeah, good to see, mate. That's how life should be lived.
Thank you. Yeah, 3 o'clock in the morning in Nashville, Tennessee came rather quickly a couple nights in a row.
Were you doing the old line dancing, or
Oh no, it's just live music and great artists. If you've never been to as I was just saying with our producer, and we were just talking about it, is the music capital of the United States, and it lived up to its name for sure.
Yeah, I've heard good things about the place, to be honest. Haven't been there myself, but I always just find myself going to Vegas and regretting it afterwards, to be honest. But one day I'll get myself out there. Anyway, a lot going on in markets. We've been away for 2 weeks, so there's probably a bit to catch up on. And yeah, obviously that large amount of that in the rearview mirror now. But I think there's some big things coming ahead which we need to discuss. So let's go into Topical Thunder and break it down. Well, let's go into markets. Pretty broad, sort of sweeping topic, I guess. But I think one of the things that has really been a very prevalent feature over the last 1 or 2 months has been this just continued rise in gold. Up she goes. And pullbacks have been very minor. You've seen massive inflows into the ETFs, and that's been a major driver of the variance of gold, and people have chased it. AI winners have been just an absolute tear. High short interest stocks have worked very well because people have had to cover the sort of lower quality echelons of the market have outperformed. Retail trader favorite baskets have worked really well. Obviously the NASDAQ continues to make higher highs, and that's been called into question now. And a lot of these momentum trades, which are just really saturated with position, everyone's been on the same side of the boat, are getting called into question. Now I've looked at not just positioning, and I think positioning is what we're seeing. Just people going, well, it's just too crowded. These markets, these positions are just too exposed and too crowded. People are just taking a little bit off the top, and I think that's obviously resonated with that 5.3% move we saw in gold yesterday. But look, I look ahead now, Blake, and I'm seeing obviously we've got US-China trade relations. We've got some big dates coming up ahead. Markets firmly of the belief that we see, the Besant vice premier talks looking okay, and so obviously then the Trump-Xi meeting leading to China sort of coming back a little bit from its rare earth situation, its export controls. The US 100% tariffs not kicking in on 1st November, and obviously then China not retaliating. Is it being underpriced? Maybe. Obviously, that would cause massive conjecture in markets. We've got the IEEPA tariff ruling, which is going to see the orals arguments being placed to the Supreme Court on the 5th of November, and we'll hear probably how that sort of goes, whether the EURJPY tariffs were legal or illegal or overuse of powers sometime after that. Not immediately, but it will take some time. We've got US earnings ramping up next week with 45% of market cap coming through. Market's just not going to take kindly to those stocks that just disappoint. So there's a lot of risk again in the system. We need risk to rally, I guess. But I think my question to you, and I've taken up a bit of time here, is these momentum trains, which are so well owned and well subscribed and crowded. Is it time to take profits? Are we buying back into the pullback that we've seen? How are you trading it?
Well, I think how should I say this? I want to say the top is in, at least near term. When I say top is in, I'm not talking the ultimate highs in the market. S&P is, and you're talking about the NASDAQ 100. S&P is trying to really carve out a lower high. Now we still have higher lows, so I'm not ruling out that we can't go higher. But at least in the very immediate near term, we have a lot of obstacles that we're facing. We have CPI, which we're going to talk about today. We have the FOMC tomorrow or next week, excuse me, in the middle of the week. So there's a few things that the market needs to digest. But I believe that before we wrap things up, before we left and did our last show, we were talking about the buy everything market and how it looked a little crowded. And it, frankly, I mean, you can see the effect of that is playing through since last Friday, or actually 2 Fridays ago, and last week. And so these markets are now in dangerous, volatile territory, Chris. And I think now you got to be a little bit more conscious of what you're buying, where your levels are. And that takes us to our next topic. And I want to talk about volatility. Volatility is on the rise. We're seeing, I posted on Twitter or on X a little bit earlier, which was a couple hours ago at the very end of the US North American session. And I was like, man, we just saw a 100-point rally off the lows in gold. Gold had nearly had a 150-point trading range intraday, Chris. I know you're going to bring up a couple of charts that are really, really wild, but this volatility, it speaks to me that this is the time that you as a trader have to be defensive. Look, what we do as traders, I've been in the markets now 30 years. This next year is going to be my 30th year since being on a trade desk. And I've been in the markets even longer than that when you take into account the years that I was a stockbroker. The fact of the matter is the longevity game in this market has more to do with how you're trading the markets during times like this, how we're being defensive, how you're really understanding what's coming at you, how volatility might affect your bottom line, and learning how to be defensive in a situation like we're dealing with right now. So I did want to have this conversation about volatility because I'm not sure what you've done, Chris, or I say you, meaning Pepperstone, but have margins increased on gold for you yet, for your traders?
On gold, on silver, and I'll be waiting to see if the futures margins start going up at all. The CME starts whacking them up. That wouldn't surprise me if that was going to be the case. But yeah, silver margins have gone up just because the craziness. I don't think they have on gold just yet. Obviously, you don't want to be raising margins unless you really have to. It's not something that people want to see. So well, hopefully that won't be the case. But we'll see. I'll let you obviously go. No, there'll be messages going out if that was the case. But yeah, look, I mean, I want to go into that gold move because you go back to the 5.3% move down, it's the biggest move since 2020. But on that day, we saw a $293 range, high-low range, which obviously a $293 range when you're trading close to 4,400 is different from a $293 range when you're trading at 2,200 or something like that. But it's still 80% bigger as a daily range than the second highest range we've ever seen. So, I mean, it was massive. And, obviously liquidity's there. And, you saw that the 1 month implied volatility in gold traded up 26%, which is one of the highest levels we've seen for ages. And so I think what you've seen in gold was just people have just been relentlessly buying up volatility, buying call options, because everything had just got so much crowded positions. You know, there was huge flows into the ETFs with the GLD, one of the biggest ones we've ever seen. 8 weeks, we've seen 182 tons of gold going into gold markets, physical gold, you know, and through the ETFs. CTAs were max long. You know, China have been buying their ETFs left, right, and center. And so people have just been going out and saying, well, probably another way to do it is just going through the options, buy call options. And then the vol just hit such a high level that, you know, the theta or the time decay became so prevalent, it just had to go up. All these options were just going to get smashed. And so I think everything, just every echelon of the financial markets towards exposure towards gold, if you're just using that, it was just ridiculous. And so the elastic band had to come unwound. Everyone was trying to get exposure through all different types of measures, and it just becomes so expensive. You couldn't hedge. When I think shorting a CFD was probably the best way to hedge, to be honest. But for a lot of people, yeah, you couldn't hedge through optionality. It was too expensive. ETFs, yeah, everyone was in it. So it was just, and obviously looking correlation, if you want to go outside of gold, gold has no real correlation to other things. So getting a hedge on was very difficult. So yeah, I think it made sense that you were going to see these huge ranges playing through. But yeah, you know, ranges do offer really good opportunity for the short-term traders, for the day traders. But as we know, when you come back to your point about defense, and I've been in the markets now for 24 years, not, you know, a little bit less than yours, but you know, still enough to know that you've just got to respect volatility. Volatility for me, realized volatility is the most important factor in financial markets. There is nothing close to it, in my opinion. You know, the options market's priced, implied vol is priced off realized volatility. You've got volatility targeting funds that drip feed capital depending on the volatility in the market. You know, it changes liquidity conditions in the market, how fast moving the markets are. To me, it is the central factor. And we use that to understand our time in the market, the risk that we take on. And so, yeah, realized volatility, how that feeds into implied levels of volatility, for me, it's central. Everyone should get an education in how volatility affects markets.
You're gonna get an education one way or the other. Let's just put it that way.
Yeah, well, that's right. The markets will school you. They will school you, and they've schooled us. Yeah, I mean that's the
Yeah.
thing. If you are going to get schooled, make sure you get schooled in small size. That's the bottom line, and you can learn some very big lessons, which of course is why when the vols are high in markets, of course you take more risk. You know, your stops have to be wider. You have to take the position size down, so your notional potential loss is the same. I mean, it's absolutely critical, and that's where, you know, retail traders will come undone because the vol will kick up like we saw in April. You get this VAR shock in the system, and they continue to, you know, to trade either with the same sort of stop they had, and they get cut out much quicker, or yeah, risk the same amount. And again, you know, so your risk needs to be dynamic to the volatility. We've talked about this before, but let's go back to the gold market because yeah, we have covered quite a bit in that. And you know, I think it's really interesting because we saw this relentless rise in gold, and you know, when you get up to sort of 4,200, 4,300, and obviously we peaked out just shy of 43.81. I think the spot gold price got to. You know, looking at client exposure, and when you see that sort of relentless rise and maturity in the rise, you would see probably 75, 80% of the client position, net position, would be short, saying that the elastic band's been pulled. The risk reward now is favouring shorts, looking for a bit of a mean reversion move. And that wasn't the case. We actually saw, yeah, very symmetrically skewed positioning. I haven't seen anything like that for a long time. Maybe people have given up trying to short it. Maybe people just wanted to go along with the trend. But yeah, it was a really interesting dynamic. People have made some good money out of gold, which is great to see. But you know, you've sort of gone through this multi-stage factor with gold. You know, central bank buying, China buying. You know, you saw this adoption trade where institutional funds were saying, "Oh, we're running sort of 60-20-20 models now, 60% equity, 20% fixed income, 20% gold," and you'd seen that in the flows in the ETFs, which were massive. Yeah, you can talk about all the different reasons for gold, and then obviously the CTAs and a big momentum chase that came through options buying. But yeah, we got to a point, Blake, where on Friday we saw 530,000 futures contracts traded. That's massive. We saw, yeah, a massive amount of optionality traded, and we saw at the time, I think we saw the gold price about 19% premium to its 50-day moving average, which is about 5 standard deviations from its long run average. So yeah, that band had just got pulled so far, bang, down it goes to the uptrend. And the question now is how it settles down. For me, I always look at this situation, Blake, and say, don't buy the dip. Buy the rip after the dip. You know, you wait for let other people to do the hard work, let it stabilize, let the sort of market structure get that, find that support, and when it starts pushing up, join the party after that. That's the way I'll be looking at it for a rerun high. That's how I'm doing it. What are you seeing?
Well, I don't want to take away from some of the charts you brought, so make sure you all stick around for them. But I come from the old school uh, thought process of up on an escalator, down on an elevator, and I'm not sure if we've got a few more floors below us that the elevator's got to come down. I think you very well in the charts that you're going to be presenting to all of our viewers. I think you've got a great set of levels that we need to be watching, but I am very cautious at this point in time. I'm enjoying trading the volatility. I've been trading in and out of gold quite a bit. It is a day trader's dream. We talked just a little bit about volatility and how you can trade around these ranges, and it's very good to trade. But I still feel that I still feel there's a little bit of a downside left in gold, me personally. But that's my own view, and I think that you got to be able to be buying those dips. Once it dips, let the market wash out a little bit. And that there's so many charts that I really wanted to talk about today, but there's a lot of markets that I think fit that category, Chris.
Before you go into CPI, I just want to say that there is nothing more important. Obviously, so the volatility, but there's nothing more important for trader than price. And you know, if the market is saturated in longs, so there's a bit of positioning has come out the long gold trade, but it's still pretty rich, very rich. There's nothing worse that causes repositioning than price action alone, right? So price goes down, and we're probably a long way from CTA trigger levels, but you start saying all the guys who are not dictated by a view on the market, the pricing, they're just dictated by what the market's doing. CTA trigger levels lower, goes down, it causes them to sell out. You've got all these people who've made some decent profits, goes down, they might look to cover. And it's just price is the most important factor there. So, if it does break the levels for whatever reason, you could just see that selling could perpetuate on itself.
Yeah, absolutely. All right, Chris, I want to talk about CPI. That's gonna round out the week. I know it's late in the day for you guys in Australia and for lots of you in Asia, but we as traders, we've been clamoring for some data to trade off of, and CPI is scheduled to be released on Friday at 8:30 p.m. Eastern time. Now they're releasing this data because they need to use it for payments, whether you're talking about different payments that need to go out to while we're in this government shutdown. But I personally think it's going to be a very binary type of situation. However, our colleagues on the UK trade off, they had actually a really good they had a good chat a couple of days ago. So if you guys haven't listened to that show, listen to the UK trade off. They talked about inflation and the CPI, upcoming CPI. But I wanted to talk about how I wanted to trade it. And I think we're going to get a bigger move, Chris, with a number that comes in weak. If we have a weak set of data, I think the market's actually going to be more responsive to that. Although I'd like to see a stronger data set. I'd like to see inflation come out a little bit hotter. I think that there's some levels that could really come into question on some of the instruments that I'm trading. But I'm going to be going over my play of the day has more to do with the inflation picture and how I want to trade it on the CPI on Friday. But how are you looking at inflation, and what are you seeing in the sessions ahead?
Mate, I look at the rates, the interest rate swaps at the moment, and they're fully pricing a rate cut, next week, 100%.
Yeah.
And then you go into the next meeting after that, which is December. There's no November meeting, and that's also fully priced 100% for a rate cut there. So the market said, look, we're done, slam dunk. It's a rate cut is coming in both meetings, and the terminal pricing's around sort of 3%. So with that in mind, I would think that it would have to be a ridiculous miss or a ridiculous beat to really jolt the market and throw conjecture, because obviously the Fed are in a blackout period now. They can't talk about it unless they go through the Wall Street Journal or something like that. But I just think, unless you saw a significant outcome from the consensus of 3.1% on core year on year, or 30 basis points, I just think the market's going to give it a big cushion, because they've just got their mind made up that we're going to get a rate cut coming through in both meetings.
No matter what.
And therefore, so I think, it's all about the jobs market at the moment. Growth's all right. And I think if there's going to be an inflation concern later on, which could see term premium rise and lift the back end of the curve, it probably isn't right now. We need to see the government shutdown resume, and that would need to see. I would look at that very importantly from whether the Affordable Care Act is the expiration is prolonged into 2026 onwards, because that would give me some belief that there's no way that the Republicans are going to get through $1 trillion worth of spending cuts around the one big beautiful bill, or whatever it's called these days. And again, then you start talking about bigger deficits, higher growth, and inflation coming through, and term premium shock. So I just think right now, look, I mean, I think probably for me, if you got a downside surprise, if the core inflation came out a surprise, really, 2.9%, then equities could rally and find a bit of love on the back of that. But from a core perspective, I think it would have to be a material beat or miss to really shudder a market that is firmly of the belief that we get a rate cut in both meetings. So I think from that perspective, its influence on rates is going to be fairly contained, and therefore I don't think it should be too much of a volatility event myself.
Very good.
Yeah. But it's important, and it's probably the first data set we've seen of any significance for a while. And I think the fact that we haven't had any data has limited the volatility to some degree in markets, because we haven't been able to price the risk around that, and the market's got hell-bent that we're going to get a cut. So I think the resumption of data once government resumes is going to be could be quite interesting in itself. But let's move on to the charts that matter. Let's go to that's the setup. All right, let's go to gold. So we're flogging it, giving it a good old run today. But you can see here, like we talked about it, all about the flows, the implied vol that we've been seeing, the massive range that you can see on that huge red candle, where it sort of almost looks like a bit of a bearish reversal pattern. I can't quite see whether the open was higher, but it looks, it's not a particularly great candle to see it at the all-time highs. Now, what we've also seen is that sell-off coincided with a move down to the August uptrend. That has been beautifully respected, where you can see on the session before, a strong wick, a long wick, as it came down into trend support, bang, up it went. So that's been respected. It becomes a key level, and that's also the 20-day moving average. Again, we're still trading at a massive premium relative to some of the 200-day moving average, 50-day moving average, if you want to use that as some sort of mean reversion tool. And as you can see on the bottom there, you can see the realized volatility, has come up to the highest levels in some time. So again, if you're trading this, position sizing still needs to be quite, relatively small, with wider stops in that situation. So the question now is does this uptrend hold? Is this the time to accumulate new long positions if you're not already in a position? You know where your risk is. For me, we could see a bit of sideways chop. The market tries to go through this journey of trying to understand what it means now, and there's no clear directional skew. So we're at the mercy of probably a bit of sideways consolidation chop as the bulls and the bear try and reestablish themselves and get a clear sense of what's going to happen. So I think that's the base case for me, is a bit of chop. But this trend is in place, 20-day moving average. Obviously, it breaks that level, and then we're at risk of a bit more of a move down. So I think that's what I'm going to be looking at.
All right. Well, I think that 4,000 level is going to be a big level. And just just for reference, I think you have to trade around that level, just because an intraday double top, based on my measurements, takes us to 39.60 or something close to that.
38.2% retracement of the rally up. Yeah.
So if you get below 4,000, just remember, this is an area. It's not necessarily if trading was an exact science, we'd all be a gazillionaire. It's not. You have to just look at these areas like 4K around 4,000, and with as much volatility as we have, give or take 50, 60, 70 points. I mean, you're in the neighborhood of 4,000. Let's just put it that way. Anyway, let's move along. I actually want to talk about the euro yen. It's not a currency that I've been really focused on because it's been quietly sitting at all-time highs and in breakout territory, Chris. And this might be one of those with the new, Takeachi. Did I pronounce her name correctly? New prime minister. She's probably going to be, she's probably going to be the new first female prime minister of Japan. She is.
Yeah.
Yeah, and she's. I mean, look, the guys that I trade with, and like my colleague K-Man, he worked on Japanese desks in Japan on FX desks. He's like, I can't find a reason to buy yen. I don't think there is a lot of a reason, and I think the euro yen really shows you that. And if you have some strong U.S. data, and let's say yields start to rally, and the yen weakens more, I think you're going to see the yen part of the calculation weaken a little bit more than the euro coming down, if you will. So I think you got to keep an eye on the euro yen. And while we're above this 175.25 level or so, you got to just respect it being a bullish breakout. But if we do break back below 175, I think that opens up the door for a gap fill, which could take us down to 173, 172 and a half range. But I think it's a good setup because we're right on that pivotal level. We are consolidating at all-time highs. Usually that's not a bearish sign. That's more of a bullish sign than anything. So keep that in mind as well.
Well, the other one is I've been looking at is Swiss yen. Because that's at all-time highs, and that's been up 8 days in a row. So that's it's a bit of a grind. The range is pretty tight. I realised vol was pretty low, but it is at all-time highs, and that's where the consistency has been. But yeah, euro or Swiss, one of the two. Again, yeah, I completely agree. There's not a lot of reasons to be buying the yen. I did say that the new prime minister, she's saying, or she has said before, that ideally she likes dollar yen at 120, 130 in that range. How she gets there, I have no idea. And obviously she'd piss Donald Trump off doing it if she was to go and start doing currency intervention to get it down to a targeted level. I think, they'd run the risk of him chucking out tariffs. Although, if the Supreme rule, it's an interesting, it's completely off topic. I'm going a bit of a segue, but one of the risks we are looking at is these IEPA tariffs, the International Economic Powers Act, Emergency Powers Act, which obviously put through a lot of the tariffs under the IEPA tariff ruling. And then there's the Supreme Court have been mulling over this and sort of pushing back the date on the findings for some time. But on the 5th of November, there is the orals argument. So the case for why they're legal and the case against why he's overstepped the mark and deemed illegal will be put to the Supreme Court. And then there'll be a decision made. I don't know, it won't be imminent. It could come out in December, could come out in January, who knows? But if the court was to deem these tariffs as illegal, I think there could be some pretty high volatility in markets. Why? Because Trump has used tariffs as his key bargaining card, and very effectively in a lot of situations. And so if he loses that, you're going to get US businesses who have had to pay tariffs coming out and saying, we want some of this back. That in itself is hard to price the risk around. But secondly, he'd have to then go out and continue to push tariffs, but he'd have to go through all these other sections 302 or 232, and that will take some time to months and months to implement it, and some of it may have to go through congressional blessing. And the ability to price risk on such a powerful negotiating tool, I think, will cause some big conjecture if it is deemed illegal. So I think that's something that we really, I think from the 5th of November, once these orals have been pushed to the Supreme Court, I think, we're going to be on headline watch. They could come out any day, and I think they'll have real meaning for the whole tariff ruling. And I think something that we do need to be concerned about.
And I'm not even sure how the markets will respond, frankly.
I think they'd get smacked.
You think so?
Well, if you ask ChatGPT what is the likely probability of a Supreme Court ruling, it will tell you that there's a higher probability than not that the Supreme Court rules them illegal. And so maybe the market's already pricing an element of in, which is probably you could argue why gold's where it is, although I think that's a long string to bow. But I think if you think about the long-term plan is that it'd still probably be able to get tariffs through at some stage. But if you go through what we're seeing with China have played hardball on their rare earths. They know they've got the market cornered with 90% of the rare earth supply. And they've put in these controls to US companies that are producing anything that has even the slightest amount of rare earths in it. And then you have to go and get a license from the Chinese authorities effectively. So they put these controls in. Trump obviously doesn't like that because he needs the rare earths significantly for so much part of the AI story and obviously for his weapons and various other factors. And so, he's threatened 100% tariffs. And China obviously don't like that situation at all. And if those tariffs were to come in on the 1st of November, then of course China could retaliate. And I think markets underpricing the risk that happens because, Trump, Besson, et cetera, have said they don't want that to happen. But the primary tool that he always comes back with, whether it's in trade negotiations or he wants to come out with an objective with one of the LATAM countries, is just tariffs. And if he loses that edge, even for a short period of time, I think that puts a lot of conjecture as to what's going to happen. So it'd be interesting.
Yes, it's going to be.
So a bit interesting. Let's go to Beyond Meats, because Beyond Meats, Beyond Crazy. If we have a look at the stock, it's traded from 50 cents up into $7.69. So 1,500% move in a few days. And we got up to 7.69, and it came back down 52% from that point. So this has got a lot of interest from the Reddit crowd, the social media crowd, because this is absolute GameStop theory 101. So obviously you looked at a stock that had very high short interest. I think short interest as a percentage of free float the other day was about 16%. It went into the forums, the shorts got squeezed, and then of course you went into the options market, similar to what we saw in GameStop, where everyone was buying out the money calls. Dealers who had sold the calls had to go and hedge because they had a short gamma position, and that just perpetuated the move. And then suddenly you got this, obviously all the sellers just stood aside and just had this one-way move, very, very aggressive move indeed. And what we saw when we're getting above $7 is people's ability to get shorts on was just knackered. You couldn't get borrow in the street because everyone was shorting it again, and everyone just smacked it back down. So it's an absolute crazy move. Krispy Kreme's another one in these meme stocks. I think it's up 60% in the last couple of days. So again, people are looking to short that one into strength. So I just think this is an absolute crazy one. I mean, Beyond Meat's trading up 1,500% on no news. It's just a pure short squeeze that were capitulated by the options market. I mean, 2.1 billion shares in Beyond Meat traded yesterday. The average 15-day average last week was trading 12 million. We saw 3.3 million options traded yesterday in Beyond Meat. That's 10 times what we'd usually see. So obviously you can understand why this is kicked on the radar. The question is now what happens. It's not something for me. I mean, I love looking at this and watching behavioral economics, and hopefully some people made some money out of this. But obviously, it's a crazy move. One that I suspect will continue because the 10-day realized volatility in Beyond Meats is now 823%, which is insane in the brain.
Have you ever had Beyond Meats like hamburger patties? Do you guys have them there?
I refuse to eat them, not because anything else, but I just we my in-laws own a cattle station, and I've just got
you're cattle farmers.
True to the word. But no, my wife has, and she said some of it's all right, but mate, there's an opportunity cost when someone puts a 300 gram or 400 gram eye fillet or ribeye in front of you, or a Beyond Meat patty burger. Which are you going to choose? There's an opportunity cost,
right. No. Anyway, it's been crazy. It's we were talking about this in our community yesterday, and the fact of the matter is, you get a lot of these squeezes. That's just this is a GameStop play. It's an AMC play. That's all it is. And it's going to be now. There's volatility injected. All eyes are on BYND, and so keep your eye on it as a setup. I
think just basically now what you're doing is you're going out and scanning all those stocks with a certain market cap and very, very high short interest as a percentage of free float. That's you're just running the numbers around those and looking at the next candidate.
Right. And and there's others out there, believe it or not. All right, Chris. Well, this one is not one of those. This is the Russell 2000, and this is going to be a setup which I think should be on everybody's radar. The reason why I say that, it's in an ascending wedge. Now, ascending wedges by definition are actual reversal patterns. They're bullish until they're not. the fact here in this particular chart, the reason why I'm bringing it to your attention as a setup is because not only is it in an ascending wedge, which is a bearish development if we break that rising trend line, but it's also a false breakout too. You can see the breakout that was over the November 2024 highs. We couldn't sustain. So now if we break the lows from last Friday, which would be somewhere around on your CFD that you guys have at Pepperstone, it's 2426, 2425, right around there, basically back below 2400. It's going to expose some downside. So keep an eye on the Russell 2000 as a potential false breakout. Obviously, you're going to want to see the S&P, the NASDAQ, the Dow in tandem, coming down as well. But I think this is a good setup because if it does break down, you're going to get some follow through just because of the setup nature of this technical pattern.
Yeah, I would have put this one in that sort of basket of momentum trades, effectively. So yeah, this is another one that I've stuck in the basket. Small caps have worked really well recently, as you can see, broken to those highs, and again, I think this is a fantastic setup. So I'm going to steal that one and push it out to clients myself and pretend it was my own work.
All right, I like it.
I'm honest. I'm joking. It was a great setup. Everyone should look at that. Let's go to play of the day. Play de jour. Well, I'm going Doge because I love crypto. I think it's one of, if not one of the best trading vehicles around. As I talk about all the time, the distribution of outcomes is symmetrical. So your moves you get on the up days can be just as big, if not bigger, than the moves you get on the down days, which is something you don't necessarily see in the equity market, for example. But if I look at Doge, we're coming into those big levels again where we saw massive buying on that fateful Friday. And, whoever, whatever, bought on that big spike on the way down. A lot of those, if it breaks through these horizontal support levels, I am short. I will be short. I've specifically chose the lower quality end of town, the crappy end of rubbish, because I still love Bitcoin. I think I'm more as a trader. I trade it two-way rather than fall in love with a position and a view that it's going up to $250 by the end of the year, as per Tom Lee. Insane, but for me, I just look at this as a price. And I think a break of those lows again, I think especially a close below those lows, and I'm going to be looking to short. Won't have a target, but I'll just let the market, keep me in the position. Probably being guided by a moving average crossover or something like that. Just keep me out. But given that we've got this risk next week, I know we've got the Fed meeting, but it's fully priced in the cut. We've got CPI. We've got these negotiations with China. EURJPY. There's a few reasons to think, which are all markets pricing a positive outcome, that we could see some de-risking coming through markets. I'm not predicting that we are, but the price will tell me that they're starting to think that. And I think in that situation, these real high beta liquidity beneficiaries will come under pressure first, which is where Doge is just a pure confidence play. And if the risk comes out of the system, some of these momentum trades roll over a little bit more. I think you're going to see Doge coming under pressure, break through that level, and through the horizontal support, and I'm short in that situation. So one that I have high watch on at the moment. I've got my levels. I'm ready to pull the trigger.
Chris, that was one of those that when I was in Nashville, Tennessee, that was going down. That all the altcoins like Doge and everything was that big candle, and I was just looking from afar, going, "Oh my goodness, those are some moves."
Well, I think when we saw that rip down and then it came back up pretty quickly, I mean, the people who would have been, the entities which would have been picking up. I mean, the top of book liquidity would have been so poor in the exchanges, and you would have just been the high frequency funds who just basically get bum, 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 bum. And so I don't know how many, retail punters have basically bought through that wick. Because I think if anyone did and it break, obviously if anyone did buy in that long wick, then if price rolls over, they're going to be offside and they're going to have to manage that, and that's probably going to perpetuate the move lower. But I'd imagine most of what we saw on that move was the high frequency funds getting in and out of positions in fairly low, very, very poor liquidity conditions.
Oh my goodness, it was crazy moves, Chris. Crazy moves. All right, well, my play of the day is going to be the euro dollar. I told you guys that CPI. I'm looking for a move here, and I don't care. I'm gonna come in, flat as far as the euro goes, but I don't care what we get. I'd rather see, I'd rather see like a weaker number and let the euro make its way back to 117, because I think this rising trend line, basically, which was very close to today's lows or yesterday's lows for you guys, which happens to be 115.65, is that level that I'm actually looking at. It's the 78% retracement. That's that rising trend line. If that level breaks on strong data, I want to get short the euro. The flip side is if we get some weak, cooling, cool CPI data, then I think we can play it to the upside and look for a move back above the 50 DMA. It's a pivot. I'm ready to trade it. I don't care what we get. I'm just like most of you guys and gals. I'm clamoring for some news. Now that we're going to get some economic data to trade from, I think you're going to get not only the move happening, but you're also going to get some follow through the day after, going into the early parts of next week. So there you go. That's my play of the day. It's the euro.
Love it. Love you. Love everyone at home. Thank you very much for following us along. If you stayed this far, respect. And we'll see you back next week for more of the trade off. Obviously, smash the like button as Blake's beautifully articulating there. And obviously, leave your comments in the comments section. Tell all your friends and your family about the show. We'd appreciate that. And we'll see you back next week for more of the trade off.